Having realistic transaction costs is an essential part of reliable backtesting. I'll first demonstrate how an incorrect spread can completely ruin your backtest. Then I'll show you how you can study the intraday spread variations of your market and suggest several ways to avoid paying ridiculous spreads.
If your strategy meets the following conditions, you should pay more attention to spread. It trades multiple times per day. Since spread is an unavoidable cost per trade, it's very difficult for retail traders to profit from high-frequency trading techniques. It trades during illiquid hours. This usually refers to the Asian session that immediately follows the New York close. Spreads tend to widen drastically because of thin liquidities in this window. And lastly, it trades on a lower time frame where your trade exit point, be it a stop loss or an indicator-based value, is likely within 10 to 20 pips. If you enter the market when spreads are high, you may find yourself immediately within a few pips of your exit. Let's check out an Asian scalper that meets the above conditions. Here's a mean reversion strategy that uses Keltner channels and the Laguerre RSI. It typically opens trades shortly after the New York close. Longs are triggered when prices close below the Keltner channel lower band, accompanied by a dip in the Laguerre RSI. I did a 15-year backtest on the 15-minute pound Canadian using a spread of 2 pips and a slippage of 1 pip, which is generally conservative if you are using an ECN broker. Results are spectacular. Are they too good to be true? I decided to forward test the strategy on a demo account and was met with a long string of losses. Turns out many trades were opened when the spread was high and were closed shortly after at a loss. It's practically impossible to make a profit with such high spreads. Did I underestimate the spread in my backtest? Let's use a spread recording program to find out. The purpose of this program is to record the current spread at the open of each bar. First, you need to create a variable that represents the current market spread. Now for our conditions and actions. If the isBar open condition is true, meaning a new bar has opened, the current market spread in pips will be assigned to this spread variable. This will occur repeatedly for every bar over your backtest period. Now we need to record the spread variable. I will use the log to file action. This will create a file that will be placed in your MQL4 files directory of your MT4 data folder. I will type a simple message where the plus spread callout retrieves the spread variable programmed earlier. Finally, I will attach the program to a 1-minute chart, meaning the spread will be recorded every minute. Here's how the notepad output looks like. Notice there is a comma before the spread value. This comma will help separate the spread when opening the file in Excel. In Excel, I plotted the current spread over a 24-hour period as shown. Spreads usually stay below 2 pips except during the 12 to 1 AM window, where spreads skyrocket to over 20 pips. This is when New York has just closed and Sydney is beginning to open. With few business transactions occurring throughout the world, liquidity is at its lowest point of the day. It is interesting that the average spread outside the illiquid 12 to 1 AM window is only 1.5 pips, which is actually lower than the 2 pips I specified for the backtest. Let's zoom in on the 12 to 1 AM window. Going from 12 to 1 AM, there is a general decrease in spread, though this is accompanied by large random fluctuations. After 1 AM, spread quickly drops to about 2 pips and stays there for the rest of the day. If you do a similar analysis, note that your results will vary depending on your broker, your market, and the day of the week. Now that you have discovered some of the obscenely high spreads during the day, you need to try to avoid paying them. From the chart earlier, it's clear you need to minimize the number of trades closed during illiquid hours, when spreads are often high and erratic. You can improve your chances by tweaking your entry and exit conditions. Let's talk about entries first. You can add a spread entry filter, which will prevent entries when spreads are above a certain threshold. For example, for the pound Canadian market above, a threshold of 2 pips would make sense. You can also add an intraday time filter that prevents entries during certain hours of the day. If your trades are held for less than an hour, it's probably a good idea to avoid entries within the 11 PM to 1 AM window. Now for exits. If you use a stop loss, which you probably should, you can temporarily disable it during illiquid hours. This will ensure you don't get stopped out because of spread widening. Of course, this also means your trade will be unprotected, but in the long run, you will probably benefit more by avoiding high spreads. If you use another type of exit, you can analyze when your trades are generally closed. Open your backtest report in StrategyQuant or Quant Analyzer, display your results in terms of trade closing time, and check out your trades by hour chart. If you have many trades closed shortly after midnight, you may want to find out how much you are losing to spread. If you want to experiment with the Spread Recorder program, the download link is in the description. Don't be a victim of ridiculous spreads, and be sure to like, comment, and subscribe.